We're jumping straight into CleanSpark today. Everyone is watching the price action, but the real story is the massive pivot from Bitcoin mining to AI infrastructure.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of this fascinating setup, do me a favor, hit that subscribe button and smash the like. We are here to simplify the noise around complex plays like this one.
So let's set the scene. It is Tuesday, February 10th, 2026. If you're just scanning headlines this morning, you probably saw a CleanSpark drop what looked like, well, an absolute disaster of a number for their first quarter earnings.
Oh, yeah. It was a bloodbath on paper. A net loss of what? $378.7 million?
Yeah.
I mean, that is almost $400 million in the red. If I'm a casual observer, I see that number and I immediately think, the company is spiraling.
Burning cash like crazy. And yet, the morning after that report came out, the stock didn't tank.
No, it actually popped 6%.
Which is the classic market head-scratcher, right? You see a massive loss, you expect a sell-off. But instead, investors are buying.
So the mission today is to figure out why. What are the big investors seeing that the headline number is hiding? Why is bad news suddenly good news?
It really comes down to looking past the accounting noise and seeing the engine underneath. Because if you just look at that bottom line, you completely miss the story. The market is basically saying, we don't care about the accounting loss right now.
Right.
We care about the empire you are building for the next decade.
Okay, so let's start with that engine then, because the growth part is definitely roaring. Despite that scary net loss, the revenue picture tells a totally different story.
It really does. In the first quarter of 2026, they brought in $181.2 million.
Just in Q1.
And that is up 11.6% just from the previous quarter.
And if you zoom out a bit, looking at the trailing 12 months, their revenue has never been. It's nearly doubled year over year.
Yeah, we are talking over $785 million in revenue over the last year. That's 107% expansion.
Which is phenomenal for an infrastructure company. I mean, usually you see that kind of growth with, software startups.
Exactly. Not companies that have to pour concrete and deal with utility boards.
Okay.
But we have to address the elephant in the room.
Okay.
If they're making so much on the top line, how on earth did they lose nearly $400 million on the bottom?
This is the part. This is where people get tripped up. Let's unpack this $378 million loss.
It's a classic case of, accounting versus cash flow. A huge chunk of that loss, about $103.6 million of it, was a non-cash impairment charge.
Okay, pause there. For anyone not fluent in CFO speak, what does non-cash impairment actually mean for the business?
Think of it like this. Imagine you bought a classic car 2 years ago for, say, $50,000. But today, the market for that model softens, and the book value says it's only worth $40,000. On paper, you've lost $10,000.
Right, my net worth went down.
Exactly. But, and this is the key, you didn't actually take 10 grand out of your wallet and set it on fire. You still have the car. Your cash is fine.
It's just a paper adjustment.
It's just a paper adjustment to reflect current asset values. That's what CleanSpark did. They had to write down the value of some older mining assets as they pivot.
So it's a bookkeeping entry, not them burning cash that threatens, payroll.
Huge difference. It looks ugly on the earnings sheet, but it doesn't impact their ability to pay the electric bill.
But the report also showed a negative adjusted EBITDA of almost $300 million. That feels a bit more real.
It is real, but you have to view it through the lens of strategy. This is what we call a heavy build phase, a CapEx cycle. They aren't losing money because the business is broken.
They're losing it because they're spending aggressively to build the future.
Exactly. Pouring concrete, buying land, setting up all this power infrastructure. You don't get revenue from a data center until it's built. Right now, they're just paying the construction bills.
So the market is seeing this not as burning cash, but as buying future cash flow.
Precisely. And that transitions us perfectly to the bull case here. Because what they're building is, it's essentially the new gold rush. We're talking about utility-grade power for AI.
And this is the pivot everyone's watching, from mining crypto to hosting AI.
Yes, because power is the single biggest bottleneck for AI right now. I mean, you can have all the NVIDIA chips in the world,
right?
But if you don't have a place to plug them in with massive, reliable power, they're just expensive paperweights.
I've heard this called the transformer shortage or the interconnection queue problem. The grid is just full.
Exactly. The grid is jammed.
Yeah.
And CleanSpark has been quietly hoarding the one thing everyone needs, access to it.
Let's look at the numbers, though. What kind of capacity do they actually control?
They control about 1.8 gigawatts of power and land capacity.
1.8 gigawatts. Can you contextualize that? I mean, is that a lot?
To put that in perspective, 1 gigawatt is roughly enough to power 750,000 homes.
Wow.
So we're talking enough power for a major American city, all controlled by one company.
And they just secured a big win recently down south, right?
They did. 890 megawatts of power capacity across Texas and Georgia.
Why is that specific number so important?
Because of the timeline. In the utility world, time is everything. If a competitor, say Google or Microsoft, wanted to get that kind of power from scratch today, they are looking at a 3 to 5 year wait.
3 to 5 years just to turn the lights on.
Easily. You have to source the land, do the studies, order the transformers, which have a 2-year lead time, and then wait in line for the utility. CleanSpark skipped that entire line.
So that's the moat. Time. They have the permit while everyone else is still in the waiting room.
Precisely. In an era of AI compute scarcity, having that power permit in your hand today is worth infinitely more than a promise of power in 2029.
It's like owning the only empty lot in Manhattan when everyone wants to build a skyscraper.
You hold all the cards. And they're not just sitting on it. They acquired another 122 acres at their Sandersville site to build out a multi-gigawatt campus.
So you have rising revenue, a massive moat with power. But let's talk about the money again. Usually, a company building this aggressively is drowning in debt or constantly selling stock.
And that's the other fascinating part. Their balance sheet is surprisingly like a fortress for a company growing this fast.
They have a safety net most of their peers just don't.
They're sitting on $458.1 million in cash. Just liquid, ready to go.
That's a lot of liquidity. But that's not even their most interesting asset. We have to talk about the piggy bank.
The Bitcoin holdings.
Yes. They hold $1 billion in Bitcoin.
It's a massive hidden asset. Think about it. That $1 billion is about 34% of their total assets. It's a huge equity cushion.
It's wild. A third of the company's value is just sitting there in digital gold.
And it gives them incredible optionality. Most companies have to go to Wall Street and say, please buy more of our stock so we can build. And when they do that, they dilute you, the shareholder.
Right. Nobody likes dilution.
CleanSpark has this billion-dollar piggy bank they can tap into. They can sell some Bitcoin or borrow against it. They don't have to dilute you to fund their growth.
So with about $1.3 billion in working capital, they are effectively self-funding this entire pivot to AI.
Which is so rare. Usually high growth means high dilution. Here, they're using their own war chest.
Okay, so that's the bull case. A Bitcoin miner morphing into an AI landlord with impossible-to-replicate power assets and the cash to pull it off.
It sounds perfect. It really does.
It sounds a little too perfect. And this is where it gets really interesting, because if it were that perfect, the stock would be way higher than it is now.
There's always a flip side. And for CleanSpark, the core issue is execution risk.
Let's get into the bear case. This is the prove it phase.
Right. We just praise them for spending all this money on data centers. But the skeptical view is, okay, you're spending it. Where's the profit?
They haven't turned that corner yet.
No. And the valuation reflects that skepticism. Right now, CleanSpark is trading at about 3.3 times its sales.
Is that high? Low?
It's actually quite low. The peer average for data center companies is around 5.7 times sales.
Wow.
So the market is giving them a pretty significant discount compared to other players.
Why? If the story's that good, why the discount?
Because the market hates uncertainty. We know they're building the infrastructure. We know they have the power. But we don't know who is going to move in.
Ah, the tenants.
Exactly. They haven't announced the big names. There's no press release saying OpenAI just signed a 10-year lease.
That's the missing piece. It's one thing to build a hotel. It's another to get guests to check in.
And until those names are on the dotted line, there's risk. I mean, what if demand softens? What if the AI hype cools down? What if a competitor undercuts them on price?
Or what if they're just not good at running an AI data center?
It's a very valid point. Running a Bitcoin mine and running a Tier 3 AI data center. They're very different sports.
How so? Isn't it just computers in a room?
Not at all. Bitcoin mining is rugged. It's interruptible. You can shut the miners off for an hour if the grid gets stressed. No big deal.
Okay.
But if you shut off a cluster of H100 GPUs that are in the middle of training a language model,
A disaster.
a complete disaster. You ruin the training run, you lose millions of dollars of compute time. The uptime requirement for AI is 99.999%. It needs a level of precision Bitcoin mining just doesn't require.
That is a huge operational leap, and if they fail at that, they're stuck with a very expensive empty building.
Precisely. That infrastructure becomes a burden, not an asset. And there's timeline risk. The return on these massive projects might not really show up until late 2026, maybe even 2027.
That is a long time to wait in this market.
It is. And while you wait, you have to deal with the other big risk.
The crypto tech.
We can't forget that. Fundamentally, CleanSpark is still a Bitcoin miner today. That's where the current revenue is from.
And that means they're completely tied to the price of Bitcoin.
Incredibly sensitive to it. If the price of Bitcoin drops 30%, their mining profitability drops by roughly 40%.
Ouch.
Yeah. And this clever hybrid model, using Bitcoin to fund the AI transition, it's risky. They need Bitcoin to stay high to keep that cash flow engine running.
So if Bitcoin crashes, the funding for the whole AI pivot could dry up.
Exactly. It's a double-edged sword.
Yeah.
When Bitcoin's up, they're geniuses. When it's down, the whole thesis gets pretty shaky.
Okay, so we have a clear divide. The bulls see a hidden infrastructure giant. The bears see a company burning cash on a pivot that isn't validated yet, all while riding the Bitcoin roller coaster.
Yeah, it's the standoff.
So for you listening, what should you be watching? What happens in the next, say, 30 to 90 days that tells us who's right?
There are a few very specific catalysts on the calendar.
Let's run through them.
First, watch Texas. We mentioned that 890 megawatts. We need to see the final utility sign-offs for that capacity.
That's expected Q1 or Q2 of this year, right?
Correct. If those approvals come through, it de-risks the timeline in a big way. If they get delayed, the stock will get punished.
Okay, watch Texas. What about the next earnings report?
The Q2 earnings in May will be critical.
And what's the magic number there?
AI revenue, specifically. It has to start showing up. If they can break $20 million in AI revenue in Q2, it proves the thesis is working. It moves it from a concept to a real business.
20 million, that's the benchmark.
It signals a real run rate. If it comes in at like 5 million, investors will get very nervous that the pivot is stalling.
Got it. And you mentioned Sandersville.
Yes, keep an eye on that site. We want to see operational milestones. Are they breaking ground, pouring foundations? Any news of actual construction is bullish.
And of course, the obvious one, Bitcoin volatility.
Always. You can't escape it. A simple rule of thumb for CleanSpark. A 20% move in Bitcoin's price swings their net debt position by roughly $200 million.
Wow. 200 million on a 20% swing. That is massive leverage.
It is. You cannot ignore the crypto charts if you're in this stock.
Okay, so how do we synthesize all of this?
I think the best way to think about CleanSpark right now is as an asymmetric bet. You are buying a Bitcoin miner, but secretly you're buying an option on them becoming a massive AI data center landlord.
It's a transformation play.
It is. The market is pricing them like a miner with some issues. That's why the valuation is low. But if they pull off this pivot, they get re-rated as a high-growth infrastructure company.
And those trade at much, much higher multiples.
Much higher. We're talking about moving from a 3x multiple to maybe a 10x or 15x multiple if they succeed. The upside is substantial.
So the trade is, you buy the miner, you wait for the landlord.
That's the strategy. But you have to have the stomach for the construction phase and trust that management can actually sign those big leases.
So here's the final thought I want to leave you with today. We talked about that huge spending, the loss that scared everyone. Is the market wrong for punishing that short-term spending? Or are they right to be skeptical until the first AI contract ink is dry?
It's the classic innovator's dilemma. Do you reward the boldness or do you demand the proof?
And in this market, proof is usually what matters. But by the time the proof arrives, the stock is often 20% higher.
That's the risk-reward trade-off right there.
And that is the lowdown on CleanSpark, a complex, fascinating pivot happening in real time.
It's definitely one to watch closely this spring.
Absolutely. Thank you for diving in with us today. If this helped you clarify the chaos, make sure you are subscribed. We break down the market's biggest moves every single week, and you don't want to be the last one to know.
Thanks for listening.
We'll see you in the next one. Keep learning.